We're 4 years in, and we've been competitive with stocks, which was the goal. Uh, and we didn't want to have any significantly painful drawdowns. And we pulled that off to a 9% max decline. Pretty competitive with the other asset classes. Uh, Having positive years every year wasn't an explicit goal because that's out of our control, right? We don't get to decide when trends develop and when risk off events actually happen. But it is a nice side effect that you typically see from all weather style programs that are designed correctly. So it's nice to have 4 up years in a row. But it is obvious if you look at 2023 what you're giving up in order to do this thing with us. You're giving up the ability to keep up with stocks during a recovery right after a significant risk off event. That is what you should expect because that's the only way we can keep that drawdown from being a big number. To get that 26.3% return for US stocks in 2023, you needed to be comfortable with a 34% max decline, unless you could market time your way to success. Because we don't believe that timing the stock market is a viable strategy, because I've never seen anyone do it well. You have to go somewhere else for this ability to manage risk without giving up all your returns. And that is what we give up, is the ability to look great during the first couple, 2, 3 innings of the recovery after a major risk off event. And that can manifest itself as relative performance that's painful, as you see in 2023. Now, this is the second time we've gone through this in our short 4-year history. It also happened in 2020. You just don't see it on here because it didn't line up with the calendar year effect. We underperformed the stock market dramatically from April 2020 to December of 2020. But we didn't go down 34% in the first quarter like US stocks did, so we didn't need to keep up with them in order to put up a competitive return for the year. That's all hidden because you're just looking at the yearly return for the calendar year. 2023 actually lined up perfectly, almost perfectly, where the amount of underperformance that we're willing to tolerate showed up in the calendar year return. And I think it's great because I don't want people buying the fund and then having an experience like this and saying, that really hurt me. I want them to know that this is the risk that we're taking in order to get a competitive annualized return of stocks, but a significantly lower overall risk. And we think it's worth giving up because, like I mentioned, annualized return is very competitive. And you're getting the lower vol and the significantly lower max decline. And the only thing you're giving up is the ability to look like a genius in the first couple innings of a recovery. Now, that's really important to some people. It's not important at all to other people. And they should be able to sort themselves out. And the ones that like what we do will do business with us, and the other ones will not.
Before we get into 2023, let's walk through performance since inception. When you look at this chart, Eric, what are some important takeaways that you see from an insider point of view?
First thing you'll notice is that during COVID, our drawdown was pretty humble relative to risk assets, which made everyone happy. However, when you manage risk and you do the things necessary to maximize diversification such that you have a smaller drawdown, you don't do so well in the recovery sometimes. Sometimes the recovery you really lag. And from that point, which I believe is early April of 2020, going forward, risk assets had really big returns and they caught up to what we do and actually passed us for a while until our portfolio or our program could reorient itself from protection stature to growth oriented posture. And then we reasserted ourselves and started making competitive returns again. And then 2022 comes along, and everyone knows what happened to risk assets in 2022. You saw us there at the end of 2021 initially have some drawdown, and then the portfolio reoriented to being short bonds and being flat, semi-flat stocks, and having some currency positions on. Which resulted in positive performance and kept us on track to deliver what we call all-weather returns. Humble, high single-digit annualized returns is the goal there. But again, if a few months or quarters later, the recovery, you never know when the recovery is going to start. You don't know when stock markets are going to bottom, but eventually they do, and they start to recover and they start to close that gap again. So, and now the S&P's actually more than closed the gap and surpassed us. So we have a very similar annualized return to the S&P over the last 4 years, but with significantly lower drawdown and much lower volatility. But it comes at a cost, and that cost is we can't always keep up with risk assets every time they rally. So, because we don't know when the market's going to bottom, and anyone who tells you that they do is either delusional or dishonest.
It's interesting. Some of the clients had pointed out that as late as October, we were competitive with traditional assets, but at the calendar year level, obviously stocks and a 60-40 did much better. How would you respond to investors asking about the gap in 2023?
So coming into calendar year 2023, we had a very defensive posture on, which served us very well in the previous year. Eventually markets bottom though, and when they rebound, they tend to rebound quickly and strongly. So we don't attempt to time the stock market. We attempt to maintain diversification, maintain discipline, and manage our risk. And that means that when something as volatile as the S&P finally bottoms and gets a bid and rockets higher, we're not going to look good by comparison. But if you were to simply recalibrate this chart to look over the last 2 years, you'd see a very different. Oh, there you go. Next chart. So same thing. Just you're looking at 24 months instead of 12 months, and you can see that our all-weather approach did exactly what it was designed to do, which is preserve capital in bear markets, be competitive during the good times, but there is a transition period. As you transition from bad times to good times, we don't know it at the moment. We have to get dragged into it by having trends change and new paradigms and themes emerge, and then our process will latch on to new themes, emerging trends, and start to transition the portfolio. But this takes time. And what you're seeing there in 2023 is that transition process.
This may be redundant, but you keep mentioning 2020. Can you talk about what happened back then?
Yeah, so we've had a few people ask us gently if we're comfortable with the fact that in 2023, the stock market was up 26%. We were only up 5.5% or something like that. And are we comfortable with that level of dispersion? Because they feel like they haven't seen that before from us. And we tell them, yes, we're comfortable. But also you have seen it before. So let's go back to early 2020. We did reasonably well during COVID, not suffering huge losses. You see our max decline down there was negative 9.3% during a period of time where U.S. stocks were down almost 34%. So people liked that. What's not so obvious is that at the lows, when the stock market finally bottomed during the recovery after that, we dramatically underperformed the stock market. So we're the blue line there. And for the next 9 months, we made about a 23% return for the year. Stocks were up 70% off the lows. So that's quite the spread that they would have experienced. And still people after that bought the fund and liked the track record because of the way compounding works. We ended up having a much more impressive compounded return over time than people were expecting, even despite that underperformance. So here's a drawdown chart, and you can see the big drawdown in the beginning of 2020 during COVID. Stocks were down almost 34. A 60-40 portfolio was down 22, and our fund was only down 9.33%. So people liked that, but you're down 34 and you come all the way back to being break even. That's a humongous rally, as evidenced right there. We did not keep up with that. And it makes sense because if we were able to keep our drawdown to some small number like 9%, yet still keep up with stocks on the upside being up 70% after that, our returns would be unrealistically high. I mean, we'd have all the money in the world in like 20 years. So it's not realistic. You got to give something up. If you want to manage risk, there's different ways to do it. If you want to have small drawdowns, there's different things that you can give up in order to pursue that. What we choose to give up is the relative returns during the first few innings of the recovery. That's the safest thing to give up, in my opinion. There are other ways to attempt it. You can take sequence risk by attempted market timing. I think it's a really bad idea. I've never seen anyone be meaningfully successful for any meaningful amount of time attempting that. You could just have lower returns overall. I don't see any benefit to that. There's plenty of products out there that are compounding at about the risk-free rate. The world doesn't need us to offer another one like that. You can attempt it through diversification, which is what we're trying to do by bringing in all the different asset classes from the macro side of the portfolio, and some tactical trend-oriented position sizing on the macro side. That's what we attempt to do. But again, what we're giving up is the ability to look like a genius during the first few innings of the recovery after the risk-off event.
Okay, you made your case about the importance of having a longer-term view when evaluating investments, but does a year like last year force you to reevaluate the strategy or make any changes given new information and new data?
There was no lesson for us to learn in 2023 about any changes that we need to make to the program. Just like there was no lesson right after COVID about any changes that we need to make to the program. So if I were to go back and tweak my research and say, you know what, I don't want these 20% gaps. I don't want to underperform the stock market for 12 months while it's in a V-bottom recovery, while it's shooting higher after selling off. Well, I've got to figure out a way to call a bottom then. I've got to come up with some set of rules that says, you know what, this thing's going to bottom, or it just bottomed, and get in early. And it'll fix that problem. It really will fix that problem, but it's going to create a whole host of new problems of buying markets that are going down, thinking this is the recovery, and then it turns out to not be the recovery. And now you're giving people huge losses on the next leg down when they signed up for all weather, not this. So you don't get something for nothing. There's a trade-off. If you want to ensure that you don't underperform in a year like 2023, you're going to have to be much more aggressive at buying stocks that are going down, or the stocks that are out of favor. And there's a cost to doing that because we'd be giving you heavy losses in a down market when everything else in your portfolio is going down. We're comfortable with the relative performance. I mean, obviously I'd rather be up, but given what I'd have to do, the risks I have to expose you to in order to be up more in a year like 2023, you're not going to pat me on the back for taking those risks long term. You're really going to be upset when that doesn't pay off. So we don't do it. If you want something that's different from stocks, and you want something that's different from bonds, well, you have to let it be different.